The pandemic that emerged in late 2019 caused widespread lockdowns and restrictions in almost every country, which affected the global economy and led to market collapses. The Federal Reserve and other central banks dropped interest rates to zero and bought various forms of debt to prevent defaults. Governments around the world also introduced unprecedented fiscal stimulus to support individuals and institutions. China was the first country to impose pandemic restrictions and is now reopening, leading to speculation about the impact this will have on the markets. In the response to the economic crisis caused by the COVID-19 pandemic, some countries, such as the United States, provided direct cash transfers to households while others, such as China, directed their fiscal stimulus to institutions. This was partly due to higher levels of savings and lower debt levels in China, which allowed households to have more runway during the economic freeze. Additionally, China's economy was not as impacted as much by restrictions, leading to a quick recovery in manufacturing production. In the West, fiscal stimulus found its way into the markets, causing inflation and leading to a spike in stock prices and speculative pumps. Disruptions to international supply chains caused shortages and delays, causing prices of goods to increase and eventually causing inflation in consuming countries like the United States. The Fed initially believed that inflation was transitory. The 2021 global pandemic restrictions led to a shortage of places where people could spend their money, which caused the epic rally in the crypto and stock markets that year. By early 2022, many countries started reopening, but China's CCP imposed stricter restrictions, which hit Chinese manufacturing the hardest. The country's economy was already struggling due to a collapse in the property sector and widespread protests. A triple whammy of new lockdowns, collapse in wealth, and watching the rest of the world reopening only made things worse. By mid-2022, most investors had sold off their crypto and stock market gains, leading to a massive crash in both markets, partly due to a rise in interest rates that made borrowing money more expensive. A shift in spending from goods to services during summer 2022 also put pressure on central banks to raise interest rates further, leading to inflation in services. The Fed didn't expect this, and the shift in spending also caused record high inventories for retailers and put more pressure on China's manufacturer-driven economy. Inflation in China has been increasing since 2020 due to a combination of lower interest rates and pandemic stimulus. China has also been buying cheap commodities from Russia and has reserves of its own. The recent Chinese New Year celebrations might also be affecting the economy and the markets, but the impact of China's reopening on the global economy is not yet clear. Some analysts believe that China's reopening will lead to manufacturing-driven inflation, but this is uncertain. The CCP is reconsidering its plans for injecting more money into institutions, and the reopening has already caused a spike in pandemic cases, leading to supply chain issues and inflationary pressure, which will only last until the population builds up immunity. In summary, the impact of China's reopening on the global economy is complex and uncertain. The large savings accumulated by Chinese citizens during the pandemic may be spent on travel and other consumer goods, which could lead to inflation in some countries. However, this spending may also be hindered by ongoing pandemic restrictions and a continued weakness in the Chinese economy. The demand for goods and the demand for manufacturing will also play a role, with the current low demand for goods and the obsession with transitioning to renewable energy sources being potential catalysts for growth. The effects of China's reopening on the global economy will depend on a number of factors.